Hey guys, welcome back. In this video, I'm revealing a powerful strategy that combines Fibonacci retracement with a secret technique I call the TLL method. This approach gives you the precision and confidence to catch high probability trades right alongside the big players. Ever wondered how professional traders set up Fibonacci on TradingView to uncover those perfect entries? Today, I'll walk you through it. We'll set up Fibonacci retracements the right way, break down the psychology behind 3 types of market structure, and uncover how to use Fibonacci for high probability setups. And just when you think it can't get better, I'll introduce the TLL method, which helps you spot smart money moves in real time. By the end of this video, you'll know how to align with the market's most powerful moves and trade with confidence. If you're excited to level up your trading, go ahead and hit that like button and subscribe to the channel for more content like this. Let's jump in. To set up the Fibonacci retracement tool on TradingView, start by going to the left sidebar. Click on the arrow beside Gann and Fibonacci tools and select Fibonacci retracement. Now, on your chart, click once, drag your mouse upward and to the right, and click again to lock it in place. Once you have the tool on your chart, right-click on the Fibonacci lines, and a menu will show up. Find and click the settings icon to open the customization options. You'll see 3 icons: visibility, coordinates, and style. Click on the style icon. Let's start by simplifying the view. Uncheck all levels except for 0, 38, 1, 50, and 61.8, keeping the focus on the most essential retracement levels. Then remove the background color by unselecting it. We can also remove the prices displayed on each level, which will help reduce chart clutter. Next, to make the tool even more user-friendly, switch the values from decimals to percentages. Click on the drop-down menu where it shows the values, select %, and now your Fibonacci levels will display as percentages. To make the tool easier to read, adjust where the percentages appear. Under Labels, select Right so the percentages show up on the right side of each level line. Then, select Middle to position the percentages right beside each line, instead of above it. Now let's make everything more visible. Set the font size to 20 so the numbers are easy to read. Then, in the level settings, choose the thickest line option to make the Fibonacci line stand out. And that's it. Now you have a clear, customized Fibonacci retracement tool on TradingView, set up and ready for effective use. First, let's go over the 3 main types of markets. Knowing which type you're in will help you decide when to apply the Fibonacci retracement tool. In an uptrending market, price moves generally higher, driven by strong buying pressure. There are 2 essential moves here: an impulsive move, where buyers push prices up, and a retracement, which is a temporary pullback caused by buyers taking some profits. This pullback creates a chance to enter as the market prepares for the next impulsive move. Think of the retracement as a pause before the buyers take control again. In a downtrend, selling pressure dominates, pushing prices lower. Again, we have an impulsive move where sellers are in control, and a retracement, which is a slight bounce as sellers pause to take profits. This pullback is often an opportunity to enter the market for the next wave down. A range-bound market is when neither buyers nor sellers are in control, causing prices to move sideways. This type of market can make Fibonacci retracement levels less reliable since there's no clear trend. For now, we'll focus on using Fibonacci retracements only in trending markets, where they're most effective. With that foundation, let's explore how to use Fibonacci retracement levels to find entry points in trending markets. The 50% and 61.8% levels are key because they often mark the end of a retracement, signaling a potential continuation of the trend. Take a look at this chart example. Here, the market is in an uptrend, shown by a strong impulsive move upward, followed by a pullback. Start by drawing the Fibonacci retracement from the beginning of the impulsive move to its peak. As the price pulls back, focus on the zone between the 50% and 61.8% Fibonacci levels, often called the golden zone. This area frequently marks the end of the retracement and signals the start of a new upward move. For an aggressive entry, you could place a limit order within this golden zone without waiting for further confirmation. Keep in mind, though, that this approach carries higher risk but can also offer substantial rewards. Take a look at this chart example. Here, the market is clearly in a downtrend, shown by a strong impulsive move downward, followed by a pullback. To set up your Fibonacci retracement, draw it from the start of the impulsive move down to its lowest point. As the price pulls back, keep an eye on the area between the 50% and 61.8% levels, often referred to as the golden zone. This zone frequently signals the end of the retracement and the potential start of a new downward move. For a more aggressive approach, you could place a limit order within this golden zone without waiting for additional confirmation. Just remember, while this method can offer higher rewards, it also carries a higher level of risk. This trading strategy of entering within the 50% and 61.8% Fibonacci levels can work, but I don't recommend relying on it alone. Let me show you an example to illustrate why. In this uptrend, we see a strong impulsive move upward, followed by a retracement. We draw the Fibonacci retracement from the start of the move to its peak and place an entry in the area between the 50% and 61.8% levels, the so-called golden zone. However, instead of holding, the market breaks through this area, heading downward and hitting our stop loss, which results in a loss. So how can we make sure the 50% or 61.8% levels will hold? Here's where I'd like to introduce you to a powerful technique I use, called the TLL method. It's simple yet incredibly effective when applied properly. With this approach, you'll add layers of confirmation to increase the chances of successful entries. Let's dive into how the TLL method works and why it can improve your trade entries in trending markets. Let's go over what the TLL method means. It stands for trend, level, and liquidity sweep signal. For a Fibonacci retracement level to hold, we need all three of these elements present. Let me walk you through a chart example to explain. As you can see here, the market is trending upward with impulsive moves followed by retracement moves. Now, here's another impulsive move that's followed by a retracement. We'll start by plotting our Fibonacci retracement from the beginning to the end of the impulsive move. If you look to the left, you'll notice that the 50% Fibonacci level aligns with a previous resistance level that has now turned into support. In traditional technical analysis, we know that when the market retraces to a support level, it often bounces. With our Fibonacci retracement strategy, we know that when a retracement reaches the 50% or 61.8% levels, there's a high probability it will bounce again. Now, we have three elements aligning. First, the trend. We know buyers are in control, so we're trading in the direction of market makers. Second, we have a key level, a former resistance that has now turned into support, aligning with our Fibonacci retracement level. All we need now is the third element, a liquidity sweep signal to confirm our entry. Here we see a clear pin bar that briefly broke below the support level and then closed above it, creating a liquidity sweep. This sweep indicates that the market is likely to continue upward with a new impulsive move. With all three elements in place, we can take this trade with higher confidence, backed by multiple confluences suggesting the market will rise. We enter the trade at the close of the pin bar, set a stop loss just below it, and target the next resistance level. Now look at what happens next. The market moves right to our target. This type of entry with the TLL method has a win rate of over 75%. When used properly, it becomes a highly effective tool to capture profitable moves. Before we dive into the next chart example, let's talk about something essential, top-down analysis. Without it, this strategy loses a lot of its power. Top-down analysis ensures we're trading with the overall market trend, which is especially important on lower time frames. Here's how to do it. If you're trading on higher time frames, like the daily or 4-hour charts, you're set. These time frames are strong enough to give reliable signals by themselves. But if you're trading on lower time frames, this is where top-down analysis becomes crucial. Let's break it down by each time frame. If you're trading on the hourly chart, check the daily time frame as your higher time frame to make sure the trend aligns. For the 30-minute chart, the higher time frame to confirm is the 4-hour. For the 15-minute chart, look to the 1 hour for trend alignment. And if you're trading on the 5-minute chart, check the 30-minute as your higher time frame. The goal is to confirm that the higher time frame is moving in the same direction as your setup. For example, if you're looking to enter a bullish setup on the hourly chart, you want the daily trend to be bullish too. Trading against the higher time frame trend can increase risk, but when both time frames align, your setup becomes much stronger and more reliable. Now let's look at a downtrend example, where we'll apply the TLL method in a slightly different context. As you can see, the market here is in a strong downtrend. with a series of impulsive moves downward, followed by smaller retracements. Here, the market breaks above this resistance level, which then becomes support as it starts moving upward. When the market makes this long retracement, it's likely to reverse around the halfway point of this downtrend move. This is where our setup begins. First, we draw the Fibonacci retracement from the start of this downward move to its lowest point. Notice how the 50% retracement level lines up with a previous support level that's now acting as resistance. This alignment is key, as it gives us a high probability level where price might reverse and continue the downtrend. So we've got our trend confirmed and we have a strong level. Now, let's look for a sign that this level will hold and that sellers are ready to push the price lower. Right here, we see a candle with a long tail that briefly breaks above our resistance before closing back below it. This movement shows that price tested the level, swept out weaker buyers, and then closed lower. This pin bar acts as our liquidity sweep, confirming that sellers are likely back in control. Remember, a liquidity sweep can appear as a pin bar, an engulfing bar, a tailed bar, or even a doji. With all three elements, trend, level, and liquidity sweep signal in place, this trade setup has solid confluence. We enter the trade at the close of this pin bar candle, set a stop loss just above its high, and target the next support level below. Take a look at what happens next. The market respects our entry and heads down toward the target. Using the TLL method with trend, level alignment, and liquidity sweep signal can make entries like these much more reliable, especially in clear trending markets. When applied correctly, this strategy helps capture strong moves with a high probability of success. Alright, that wraps up this strategy. I hope you're excited to start using these techniques in your own trading. If you found this helpful, make sure to subscribe and turn on notifications so you don't miss future strategies and tips. Drop a like if you enjoyed the content, and feel free to leave any questions in the comments. Thanks for watching, and I'll see you in the next video.